Attention, everybody. The views and opinions expressed on the show are not necessarily those of Acts Ministry, Acts Media Group, and/or their affiliate and subordinate ministries and/or nonprofits. So now, without any further ado, backed by popular demand, it's the man with a plan to put gold in your hand, Tony Hammock.
Thanks, Matt. How is everybody out there in Axe Media Land? It is Wednesday, the 26th of August. I'm supposed to be up to 90, I think, today here in southwest Missouri. And it is a fantastic morning out there. Hopefully you're able to enjoy it wherever you may be viewing from. And I'm excited to get the show started here, although I will tell you I'm just a little bit saddened. This is the first show in a while that I haven't had a wingman with me, so to speak. You know, for those of you that watch week in, week out, you know that for 3 months, I think, we had Asa, our 19-year-old, coming in and helping out. And then last week we had Luke, the 13-year-old, who did a wonderful job and stuff. And both are back in school for the moment. Although I think Luke is doing his all remote with the computer and all that kind of stuff. And Asa's over at Tulsa, going to the University of Tulsa, starting his sophomore year. So anyway, that's our family update. But I think I have some things that'll be of interest. And what I was thinking I would do is, why don't I start out with the devotional from our stewardship class and kind of get that out of the way, just because I've got it kind of queued up on my phone here. And then we can move on to some other things that are more timely as far as the industry and everything that's going on. Needless to say, there's been a lot of activity since last Wednesday, and it's going to continue to do that for the rest of the year, probably. I mean, you know, we've just got a lot of different things in motion, and you know, the one thing that everybody's kind of getting probably already tired of is the fact that it's an election year, and you know, that'll be in November. So my hunch is between now and November, you're going to see a lot of volatility in the markets. And then once the election is over, we'll kind of see which person wins, and you know, that may determine whether there's more volatility or if things kind of settle down just a bit. So we'll find out. It's, you know, it's day in, day out. I mean, you know, if you're bored, just wait a few minutes and things will change and stuff. But without rambling any more on that, let's get into today's devotional. Let me get my glasses all around this here. Oh, you know, I wore the wrong glasses today. So let's do this. I will try and do this without glasses. This one is accepted, protected, and cared for. Mark chapter 5 tells the well-known story of the woman who had an ongoing blood-related illness. According to the purity laws of the Old Testament, a person with an issue of blood was in effect permanently quarantined. She would have been shunned by her community, even her own family. A woman with this problem was simply not welcome in society. One day, likely from the periphery of the crowd, she spotted Jesus walking along. In utter desperation, she pushed through the throng of people surrounding him and managed to grab the hem of his cloak. Immediately, Jesus wanted to know, "Who touched me?" I wonder how this lady felt in that moment. Culture said that she was an outcast, unacceptable, unclean, unworthy, certainly not allowed to touch a man, let alone a rabbi, let alone Jesus. I imagine she must have braced herself for a rebuke and further rejection as she took a deep breath and in fear and trembling replied, "I did." Jesus' response to her is nothing short of breathtaking. Reading this event through the filter of the modern Western mindset, it's hard to grasp the full impact of what Jesus did and said as she stands before him in her uncleanliness, despised and rejected by society, waiting for yet more scorn. Jesus looks at her and says simply, "Daughter." The root of the word translated here as daughter means accepted, protected, and cared for. What an amazingly outrageous, culturally unacceptable, wonderfully politically incorrect statement. As well as healing her with a single beautiful word, Jesus wiped away all of the rejection and shame this woman had suffered. He speaks the same thing over you and me today. Accepted, protected, and cared for. The truth is, no matter what you feel about yourself, what others have said about you, or what you have or haven't done with your life, you are accepted, protected, and cared for by God. Regardless of the situations you found yourself in, and the bad decisions you've made over the years, you are accepted, protected, and cared for by God. No matter how much of a failure you feel and now and how eaten up you are with shame and guilt, you are accepted, protected, and cared for by God. However unclean you feel, or however unacceptable you think you are, He calls you accepted, protected, and cared for. So, like several of these classes in this particular course, it's very powerful and actually kind of interesting as far as the timing with everything that's going on with the COVID-19 stuff. I mean, you know, it's just, either you've got the mask on and you're feeling paranoid because somebody doesn't, or, if you're like me, every once in a while I forget my mask, or I open the front door without a mask, and then the other person's all bundled up with a mask, and, there's all kinds of weird emotions that come with either side of the fence you're on and stuff. My wife cracks up a couple Saturdays ago. We had just gotten home from some errands and stuff, and it was about noon, and I saw the mailman pull up out front, and he was getting out of his little truck, and he was coming up the steps to the house with an armful of boxes and envelopes and stuff like this, and I thought, oh, I'll do him a favor. I'll run down and keep him from having to climb the stairs to the front door and stuff, and so I met him about halfway, and just before I had noticed that he was coming out, I had taken a handful of peanuts and, was just kind of snacking on them and everything. And so this guy, he bends down and he puts all the packages down on the sidewalk, and he's doing his little scanner thing and stuff. And I had a cough, and it wasn't like a COVID-19 cough or something, a respiratory problem. It was more or less, I had a peanut that, kind of went down the wrong way or something, And this guy, his response was, "Hey, thanks for coughing on me, man." And, I won't tell you what I actually said. But I did notice that this guy didn't even have a mask on. And, it just really upset me that here he was, kind of casting, comments at me as far as my lack of cleanliness and stuff. And here he didn't even have a mask on. If it was that important to him, he should have had it on. So, I can kind of identify with the character in this story, and, I just think it's really powerful. I don't know if you remember, if you watch Week In, Week Out, how I came across this particular lesson, but, we're on the third one now, so I guess 3 weeks ago, I was kind of looking through my program that has these stewardship courses, and I thought, you know what, I'm going to put in gold and just see if something pops up. And sure enough, there's one called gold. And so, because we talk about gold and silver quite a bit on the show, being alternative assets and everything. And so I got to looking at it, thinking, oh, it can't be about precious metals or anything. But as it turned out, it was about gold, but more about human gold, like uncovering things about us as humans that are treasures and things to be have passion about and all that kind of stuff. So, excuse me, I went ahead and used it that week, and as you can tell, we're now on the third one. So I kind of like its irony that it's not really about gold per se, but it is a very nice application for that part of our show and stuff. Anyway, that is the devotional for the day. Let me just see if they give us any Bible verses. Mark 5:25 to 43. So that is my story. So if you've been tracking the world of gold and silver, you know that there's been a lot of things going on. And what seems to be driving the price of gold, especially here lately, is the strength or lack thereof of the U.S. dollar. And we could probably spend the entire show talking about the U.S. dollar and some of the things going on there. As far as pricing goes, let's start with Bitcoin, because we keep threatening that we're going to take a show and talk about Bitcoin and the cryptos and stuff like that. Right now, as we speak, Bitcoin is, let me see, it's up 1.16%, and it's at $11,473 per coin. And Ethereum, which is another crypto, if you're not familiar with it, that's at $387.96 a coin. And then Litecoin is $58.38 a coin. And those three probably make up, 90+% of the market value of cryptos: Bitcoin, Ethereum, and Litecoin. Let me see if I can get over here to the gold and silver. There we go. Now, remember, these first prices I'll read, these are by the ounce. These are precious metals. Gold, as of 9/12 this morning, is at $1,929.30 an ounce. Silver's at $26.91 an ounce. Platinum is at $931. Palladium's on the move. It's up $16 today. It's at $2,227 an ounce. And then everybody's favorite, rhodium. Rhodium is at $11,700 an ounce. Now think about that for a second. An ounce is $11,700 of rhodium. And as we've talked about before, platinum, palladium, and rhodium are used quite a bit in automobiles, specifically the catalytic converters and stuff. So those could be reasons why. Now, the next metals are the base metals. So these prices will be by the pound. Copper is at $3 even. Nickel is at $6.82. Aluminum is at $1.05. Zinc is at $1.11. Lead is at 88 cents, and uranium, which we kept teasing Asa was his favorite one day, but anyway, uranium is at $30.75. Crude oil is $43.51 a barrel, and the Dow Jones so far this morning is off 35.75 points. It's at 28,212.69. So we've had some interesting developments there and stuff. I do have a new program. If I can find it real quick, I'll see if I can share a couple of things here with you that might be of interest. Gold. So gold right now at looks like $19.30 for the last 30 days is now down 0.71. So it's not down 1%, it's down 0.71 in the last 30 days, which is quite a change there, because it was on kind of a nice run there in late July and early August. And for the last year, gold is up 26.37%. So, by most people's standards, that would be a nice return on an investment. Now, silver, on the other hand, over the last 30 days is up 8.9%, very respectable. And over the last year, silver's up 52%. So, once again, even though we talk more about gold, it seems like a lot of people are of the opinion that silver is probably the way to go, at least for the short term. Usually silver is more volatile than gold, and a lot of the folks that I follow as far as portfolio allocations in these two, they kind of urge folks to have 75% in gold and 25% in silver, and then reallocate every 30, 60, 90 days, whatever makes sense and stuff. If somebody's a little bit more bold, they can have higher weightings towards the silver, and so forth. But that gold-silver ratio that we talked about so much earlier in the year, I noticed last night it was down to about 76, which is more normal. At one point earlier this year, it was at 123. And if you're not familiar with that, that's where you just take the price of an ounce of silver and divide it into the price of an ounce of gold. And historically, historically, it should be about 30. Over the years, people have kind of gotten to where they are okay with it around 60. So earlier this year, when it was like 123 or 126 or something, it was just way, out of whack as far as silver needing to have a little bit more value and stuff. And then it did. I mean, it went from, I want to say $12 an ounce in March to where, today it's at $26.90, I think, an ounce. So, a very nice rebound. Now, there's a lot of folks out there that are talking that silver, may get over 50 here, and there's folks that are, saying it could get over 100. The disclaimer we always use is prior performance is not indicative of future performance. And, the interesting thing about these markets, stock markets, bond markets, gold markets, silver markets, futures markets, all these different markets, all markets. What's interesting is nobody really knows. I mean, there's a lot of people that get paid a lot of money to tell you what they think will happen. But in reality, nobody knows because there's just so many moving parts to these markets. And as I said a minute ago, right now the dollar seems to be weakening. I mean, it's weakened quite a bit since the beginning of the year, and that's why you've seen gold have such a nice run, because a lot of people look at those two in tandem. If the dollar gets weak, they'd much rather have money in gold. If the dollar strengthens, then the dollar's okay. And what they're doing is they're measuring the dollar against kind of an index of 6 other currencies. And so when you look at what's happened this year, for example, the dollar is still, for the moment, the reserve currency of the world. And that's something that was created back in 1944, at the Bretton Woods meeting in New Hampshire. That was right there at the tail end of World War II. And all the United Nations countries got together there, and they decided they'd make the U.S. dollar the reserve currency of the world. And so what happens is that a lot of folks use the U.S. dollar as kind of a settlement currency. So normally, when, let's say, Russia is going to buy something from China, what they would do is they would take their currency and convert it to dollars, give those dollars to China for whatever the product is. China would accept the dollars and then possibly convert them into their currency. Kind of depends on the value of the dollar versus their currency. And so that's normally how that works, with it being the reserve currency. Well, since the beginning of the year, Russia and China, and that's why I use them in this example, have been trying to bypass the U.S. dollar, and they've been trying to go direct and settle things with their own currencies, and so therefore the demand for the dollar is off like 35%. So that's one of the indicators, or I should maybe contributors would be a better word there, of why the dollar has been weakening. The other one, which is kind of the no-brainer one, I mean, if you really think about it, is ever since COVID was classified as COVID-19. I mean, think about the first of the year. January, we kind of got in there, and then February, and then all of a sudden, we got word that there was this virus in Wuhan, China, and of course it started spreading our way, and here we are in August, and we know what's happened and stuff. Well, our government, our Federal Reserve and the Treasury Department, they started basically printing money. And so all of a sudden, if you're adding more money, more supply into a market of any kind, you're going to see the value go down. And that's kind of another real big contributing factor as far as the dollar is that all of a sudden we've got another, I don't know, what is it, $6 trillion out there that have been created by the Federal Reserve. I mean, they're actually to the point now where they're buying ETFs and bonds, and there's talk that they may actually buy stocks. I mean, they're buying corporate bonds. So anytime they're doing that, when they buy something, they're buying with this supposedly unlimited pocketbook here, and they're buying and they're putting cash into the system. And so with another $6 trillion in the system, it's been a big factor in why the dollar has come down in value. If you look at it, I think there's something like 47% of the population of the United States that if they had a $400 unexpected expense, all of a sudden they went out and they had flat tires, they had to replace them, or the air conditioning unit went out, or whatever it could be. Their little one fell down and broke their arm. I mean, God forbid that, or any of them really, for that matter. But the point is that if they had an unexpected expense of like $400, they couldn't pay for it. They'd have to either borrow money, put it on a credit card. I guess some may steal. I mean, I don't know, but it just seems like that is a terrible, desperate number, for a country that is supposed to be, the biggest and best country in the world, that 47% of the folks couldn't do that. And that statistic actually is, from like 2018, I believe it is. If you start thinking about what's happened just in the last 6 months, I bet if we could have them redo that, you'd find that that's probably much, much higher. It's probably closer to, 67%. Or maybe higher, because I mean, what do we have? Something like 30 million people out of work, and it always depends on who you get those statistics from. One place says we've got 30 million, another place says we have 40 million, but the bottom line is we got a lot of folks out of work. I just noticed earlier this week that American Airlines and seems like there was another airlines that are laying off, like in American's case, I think they're laying off 1,700 pilots. Now think about that for a second. I mean, they don't have much demand for airfare, do they? If they can lay off that many pilots and stuff. So I'm sure we've got an interesting number, if the truth be known. And, part of it is just the normal cost of living going up. I mean, excuse me, we all kind of deal with it month in, month out. There's way too much month for the dollar, our personal budgets and stuff sometimes. And so, some people work 2 jobs. I mean, there's a lot of folks that are delivering for, what is Instacart and Dash and, some of these other Uber Eats, things like that and stuff. So, we'll see that going probably more in that direction. But I mean, just, here again, even before the pandemic, the cost of heating or cooling your home was up like 100%. And healthcare, I mean, my goodness, think of healthcare just since the beginning of the year as far as its escalation. And, you've got your food. I mean, if you're now having to call Instacart to get your food delivered, you got the cost of the food, plus you got the cost of the delivery, and probably a tip for the driver and all this kind of stuff. So, it's kind of like easy to see where some of this has come from. And, I mean, when you start thinking of education, college tuitions, I mean, they're up. And my hunch is they're not going down anytime soon. I thought it was really interesting because in the last couple of weeks there's been a lot of stories of some colleges that during the summer, they went ahead and billed the parents for the tuition, and, they're basing that tuition on the child being at college, on campus, going to class, and getting smarter. And there were several of them that they got their tuitions paid for, and then, God, which one was it? I think it was the University of North Carolina at Chapel Hill. I mean, within a week of classes, said, "Oh, that's it. No more classes in person. Everything is remote." And so, I don't know about you, but I'm just thinking maybe that tuition shouldn't have been, the same and/or the same plus ratchet up, because that's kind of the norm with college tuition and stuff. And it's across the land. I mean, there's just a lot of colleges that, you look at the annual increase in tuitions, and they're going up. So that is one thing to be aware of. But my point back to the people that can't take a $400 expense and take care of it without credit and stuff, it's one of those things where if you start looking at it over time, back in 1965, an ounce of silver was $1. So you could have gone into a Brahms store, for example, or Hy-Vee or Price Cutter, wherever you would like to get your dairy products, and back in 1965, and you could have bought a gallon of milk for $1 or an ounce of silver. If you went in today and you had $1, do you think you could get a gallon of milk? I don't think so. But if you had an ounce of silver, at what, $26.90 an ounce the last time we looked here a few minutes ago, you'd be able to get several gallons of milk. So the silver kind of did better over that time frame than the dollar. Or we can take it a step further. We can look at, what if you had a car? Back in 1965, and that's an easy year to start with because the dollar and an ounce of silver were exactly the same. But in 1965, if you had gone and bought a brand new Ford Mustang, that was Lee Iacocca's baby, what was supposedly the car that was going to save Ford, and obviously it did, it would have been $2,500. And you could have paid $2,500 cash, or in this example or comparison, you could have paid $2,500 or 2,500 ounces of silver, and you would have drove off the lot with your brand new Ford Mustang. If you went into a car dealership today, or a Ford dealership today, let's say, and you wanted to get a brand new Ford Mustang, and you had $2,500 of cash, how far would you get? You wouldn't get very far. I mean, maybe it'd be a down payment. I don't know. They may want 20% down, so, you're going to need a little bit more there. So, I just don't think you would drive off the lot with a new car for only $2,500 in cash. Although if you had 2,500 ounces of silver in today's market and you walked into a car dealership, you could probably buy two Ford Mustangs. Now, granted, maybe they're not the leather interior V8 souped up Mach 1, type ones, but they're still sporty, probably 6-cylinder cloth interior, and they're brand spanking new. And you'd be able to probably walk out of there with two of them. So that's, there again, a nice comparison of the dollar versus silver. Or we could switch to gold. Let's say in 1965 you had $10,000 and you wanted to buy a house. 1965 you could have bought a nice 3-bedroom, 2-bath ranch, probably somewhere here in Springfield or Greene County. And, houses back then were built nice, so it's probably still around. In fact, by all the real estate statistics and so forth, it's probably now worth about $85,000. So that's not a bad return. You put $10,000 in the real estate back in 1965, and today it's probably worth, $85,000, $86,000. And you've hopefully taken care of it, and it's a nice place to live, or now you're using it as a rental, whatever the case may be and stuff. If you had taken that same $10,000 back in 1965 and you had put it into gold, okay? Gold back then was about, I want to say, $35 an ounce. You'd have bought, I think it was 231 ounces. My math might be off 1 or 2, but it's not too far off. And that $10,000 in gold today would be worth over $500,000. And I mean, I could sit here and do the math and give you an exact dollar amount, but the point is it would have gone up considerably. Now, I mean, where would you have lived? Well, in this example, you probably could have rented for a while and then afforded to buy a house. I mean, at $500,000 right now, you could afford a very nice place to live and still have some gold left over. But those are just some nice comparisons that we've used before on the show with our presentations. And let me see if I can get my little laptop here to fire up. Give you an idea of why it might make sense to have gold and silver in your portfolio, and to maybe not store so many dollars in cash. You know, I will tell you that there's an interesting thing going on around the country, and that is that some of these banks and credit unions and so forth are changing some of their rules. And I don't know what's up with this, but I mean, just in our case, my wife has a little checking account at a local credit union, and which I'll leave unnamed, I guess, you know, for the moment. But anyway, she got a notice the other day that going forward, if she deposits a check in there, the most she can have in cash. Now, this isn't like a payroll auto deposit, you know, but this was like if she walked in to the teller window or the drive-through and put in a check, the most she could get in cash out of that check would be, I think it was $250. And then after, I want to say 11 days, it was $1,500, and then after a few more days, you know, it could be as much as like $5,000, you know, so it'd be a nice check we're talking about here. But my point is that it's not like the old days where you walk in with a check and, you know, you go to cash it because that's where you bank, and, you know, because they've had your account for a number of years or whatever they're looking at as a judgment call, you know, they cash the check 100% and give you the cash. I mean, you know, it's kind of interesting how some of these things are gradually starting to change. And, you know, I had a conversation with a lady here last Friday, and she and I were talking about banks, and she had a large amount by my standards in a checking account, and we were talking about it, and you know, something came up about why wouldn't she want to keep it there, and I said, well, I said, keep it there, you know, I mean, but what I would do if it were me is I would pick the weakest bank in your area to keep it in, because if something awful happens with the bank situation, the FDIC would probably be able to cover the first bank or two that they had to cover. But if you're in a strong bank and it's able to survive for a while, by the time it has issues, and of course we're talking catastrophic type stuff, and you know, the sky is falling and stuff, so please don't run to your bank and, you know, cash anything out. I'm just talking as far as a conversation I had with this lady, and I think this part of it is true, that, you know, it may be that the FDIC is depleted by that time. I mean, you know, all these government entities, they don't have the vast resources that maybe they once did. And so it just, you know, I wouldn't rely on the FDIC for very much. I mean, there are some nice vehicles that you can use to keep your money safe and not necessarily 100% in the bank. Banks are great. Banks are a vital part of most financial plans. You know, you need them to have an ATM card and a checking account and you know, maybe a safety deposit box. You know, those kinds of things. If you ever need to borrow money, obviously that's where the banker will come in, and of course they'll charge more on the loan than they pay in the savings account and so forth. That's kind of how they make their money and so forth. But you know, I'm not saying banks are bad. I'm saying banks are fine and everything, but there are some alternatives out there. You know, one alternative might be insurance companies. You know, insurance companies are, for the most part, are pretty strong. I mean, there is a rating system out there. There's AM Best, and there's Moody's, and there's S&P 500, or S&P Standard & Poor's, and a few others that my mind will probably remember here in a minute. But you know, these agencies evaluate these insurance companies on their claims paying ability. And there's a lot of insurance companies that are, you know, A+, A-, and they are very, very strong as far as their assets and stuff. And I mean, they have a plethora of products out there that, you know, might be a nice alternative. They have fixed annuities that pay a competitive rate. This woman I've mentioned before, you know, she and I were talking about a single premium universal life policy that had one option that was paying 3.45%. Guaranteed 3.45, tax deferred, and then down the road when she decides she wants to take any money out, it would be tax-free if she, takes it out as a loan. And without getting off into the minutia of, how some of these insurance policies work and so forth, I mean, it was a very nice rate, 3.45, versus, anything she was seeing around the community she lives in and so forth. So anyway, just, food for thought there, that there are options out there. And if you ever want to discuss options, I mean, if you've got an advisor, a trusted advisor, please, give them a holler or go see them. I'm sure they probably have, a couple of ideas that they think might be best for your situation. I mean, everybody's case is different. It's case by case. Not one thing fits every account. But if you don't have somebody or you want a second opinion, give me a shout. I'm at 417-755-0700. You can send me emails at tony@thegoldaffiliate.com. I have a number of insurance companies that I work with, and some are A+, some are all the way down to A-. I don't really deal with companies that are below A-, just because I don't need to. Most of the solutions that I'm trying to find can be dealt with by the companies that are A- or better. And so, I mean, there are companies, insurance companies out there that will be, triple B, double B, single B, and so forth. But and you'll find higher interest rates and so forth from those companies. But like I said, for my sense of comfort, I kind of like to stay with A- or better. Anyway, that's probably enough about that. Let's see what else we can get into here on the first show post Asa and post Luke. There's just all kinds of things going on, and one of the things that I recently did was I opened up a little account with, let me find it here, Robinhood. And Robinhood, if you're not familiar with it, is this online brokerage account, I guess you could call it. And what spurred me to do this was a couple of Fridays back when we found out that Mr. Buffett, Warren Buffett, from Omaha, he's the gentleman that runs Berkshire Hathaway and is one of the wealthiest folks in the world, let alone the country. It got disclosed from an SEC filing he had to make for Berkshire Hathaway that he had basically, well, this kind of dovetails with the bank story. He had basically unloaded a number of the banks. He's always been a big fan of banks, and they're very profitable and stuff. But he had unloaded, I want to say Goldman Sachs and J.P. Morgan and some of his Wells Fargo position. I think he was hanging on to his Bank of America, and there might have been another one in there. But the proceeds from those sales, a lot of those proceeds had ended up with a company called Barrick Gold. And Barrick Gold is the largest gold mining company in the country, maybe the world. Excuse me. And so, to complement the gold and silver that we've been accumulating, my wife and I thought, well, let's take a look at Barrick. So that weekend I got in and I was kind of looking at, their fundamentals and, their dividend and their earnings, and they're having a very good year, as you might imagine, because of the activity going on with the gold market. And so, and I mean, we're not talking any large amount for me. I mean, nothing like his, 29 billion or whatever he put in. But the Robinhood account was kind of neat because it's online and they don't charge a commission for the most case. I'm sure there's something you could probably do in there that would generate a commission at some point, but for little transactions like these and stuff. So I was able to put a few dollars into Barrick Gold, and I'm just finding it to be kind of a fun little sideline because they've got research and they've got trading, and you can get into all kinds of other things, some that I wouldn't encourage anybody to get into unless they have a lot of experience and stuff. But here's the neat thing about it is when you open your account, you get 1 share of stock free. And in my case, since I already have an account, I can send a link to my social media or to people I know, and if they click on that link, they go to Robinhood, and then if they open an account, they get a share of stock free, and I get a share of stock free. And I will admit, the stock that I got free was a small energy company. I mean, you know, it was, I think, $4 or $5, which, you know, wasn't earth-shattering, but it's kind of fun. I kind of watch it and everything. Now, they do supposedly do random drawings from like 200 different companies in the mix, and they claim that you could end up with one share of, you know, some of these ones we hear on the news all the time and stuff like that. So, you know, if you're lucky enough to be the recipient of that, you know, power on, more carry on, so forth, and everything like that. But if you needed more information on it, you could go to Robinhood.com, and it's ROBINHOOD.com. I would not get involved with it necessarily if you don't know what you're doing. And if you do with, you know, I mean, if you kind of got in there and were like, okay, you know, maybe I need to think about this or something, you know, you're always welcome to give me a call. And, you know, not that I would give you any advice per se, unless we were actually sitting down and I understood what your objectives were and stuff, but they're pretty thorough in the new account process. They want to know, you know, what do you want to do with these dollars? Do you want growth? Do you want retirement? You want income? You want capital preservation? You know, those kinds of things and stuff. But it's been kind of a fun little diversion for me, just because they've got some interesting articles they pull from. And of course, you know, I'm focused on the ones that are about gold and silver. And I did find a couple of ETFs that were based on small gold mining companies and silver mining companies. And so, you know, there's just all kinds of things you can do there. But anyway, I thought I would mention that just as a sideline, that if you're interested, you know, you can definitely check that out. I mean, that's the thing, is anymore in this day and age with the technology that we have and everything else that's going on with, you know, these apps for our phones, and everybody's kind of going to the internet and stuff. I mean, you could really get most of everything you need research-wise to, you know, make an educated decision. And I think that's kind of why Jim Whiting and I got together over a year ago and brought this show back. You know, the New Gold Standard, as we're calling it, is this, that, you know, there are alternatives out there. It's not all, you know, what you hear from the talking heads on TV. You know, when oil a while back got down below zero, remember that show? I was saying, geez, if you could make a, you know, a position in that right now, it might make sense. And of course, oil today is over $42 a barrel, and that's been in like 2 months. So, I mean, there's things out there that, you know, we will talk about and try to provide more information and education on. Not necessarily that they're good for your account, but it's knowledge, and knowledge is power. And you never know when you may need that. I mean, you may be in a conversation where somebody is trying to coerce you into buying something, you know, at the water cooler or the coffee pot, you know, where they're like, oh, hey, I just bought XYZ stock. You really need to get into it, you know. And rather than make that impulsive decision to do that, you know, you've got some places to go to research it yourself. And, you know, from there, make a decision on, okay, well, then maybe this makes sense. Think about some of the shows that we've done in the past where we've talked about dollar cost averaging. You know, there's a lot of things right now out there that are at their all-time highs. You know, Apple Computer, Tesla, Netflix, you know, all these glamour stocks. And, you know, some of them, you know, my hunch is that they're getting higher just because, you know, it's in the news and people are talking about them. But if you start looking at their fundamentals, you know, their fundamentals are off the charts. In fact, I was watching a video yesterday of one of the research gentlemen I really like and trust and have a lot of faith in and stuff. And he was comparing like 3 stocks on their price to sales ratio. And there was a couple of those glamour stocks that were, off the charts in what you're paying for them based on the price today and the actual revenue they generate and stuff. So, dollar cost averaging, a systematic approach. That way you're able to, not jump in to a situation where you may be buying high and, it's not the prudent move and stuff. And, I told you, I think last week, I've seen Peter Lynch. This is going back 2 decades ago, but at a big conference in Denver, I believe it was, where, he was talking to a ballroom full of 1,000 of us, financial folks. And his fund there for a long stretch was the #1 fund. If it wasn't #1, it was right there. And, he made the comment that, 85% of the people in his fund, which was the Fidelity Magellan Fund before he retired, lost money. And, everybody was looking at it, how can you lose money in the Fidelity Magellan Fund, And he was saying, well, he goes, we keep statistics on this kind of stuff, and most people buy high and they sell low. And the reason they're buying high is they're reading some of these Money Magazine articles and, all the different publications you see at the bookstores and everything, and, some article out there about, now's the time to buy this, and it's probably the exact opposite. In fact, years ago, when I was actually doing a lot more in that area, there is a chart out there. I'm trying to think of the actual name of the chart, but that'll probably pop in my mind here in a second. But basically, they had all the major sectors. They had large cap stocks, small cap stocks, muni bonds, emerging markets, treasury bills, basically every category that you could think of to allocate your dollars to in a portfolio. And what they did is each category had its own little color. Well, then they went back, and they went back like 15, 20 years, and they'd have like for let's say in this case we're in 2020, for the year 2000, they'd rank them as far as their performance. So maybe #1 in 2000 was, emerging stocks, and #2 was corporate bonds, and #3 was municipal bonds. I don't know, I'm just pulling those numbers out of my head for this example. And then the very next year, in this example, 2001, you'd see that whatever was #1 in 2000, in some cases, it dropped all the way down to the bottom. And it was just amazing to see, and vice versa. Sometimes you'd see something that was on the bottom in one year, and then, the next year it's towards the top and or all the way to the top. And it just was a great tool to use when talking to folks, because it proved that there was a lot of momentum created by the media and things like that maybe wasn't the way to go. In another conference I was in years ago, and I know I'm running out of time here because Matt's already poked his head in here once, so I'll kind of wrap up here. And this gentleman has long since retired, but I remember we saw I want to say it was the president of the Oppenheimer funds. Now this is going back 20, 25 years ago, but he was the keynote speaker at a conference, and he was making the comment that his 401k with his own family of funds had done quite well. But what he did was every year on January 1, he went into his account and he put 50% of his 401k in the worst performing fund from the year that just ended, and he put the other 50% in the second worst. And then he just let it go for a year. And then January 1 the next year, he'd do the same thing. And, basically he was buying low, and in most cases, when he had a chance to come out a year later, selling high. And that's kind of what we really, want to strive to do. We don't always do it. I equate it to, like a shoe sale at the store. All of a sudden you find out that the shoe store's got a sale. Well, you want to go in and you want to buy shoes then. You don't want to wait until later in the season when there's no sales and you're having to pay full price. And if you can think about those kinds of analogies when you're looking at some of these things like gold and silver and platinum and palladium and oil and and stocks and bonds and all this kind of stuff, it just starts to make a lot more sense. That's what the big guys are doing. The institutions that deal in amounts that have lots of zeros after them. Is they're trying to go in and in some cases be contrarian. And that's probably the note I would end on, is I've always found that trying to be contrarian is the way to go. In other words, if everybody's jumping on XYZ, let's take a look at what else is going on there and stuff, because there might be just too much hype going on. And sometimes you can tell by what's called a PE ratio. And a PE ratio is price divided by earnings. And, I think the S&P, the average PE ratio is, I don't know, I haven't looked this morning, but, usually you want to have it probably, high to mid-teens. And so if you're ever looking at a company and there is no PE ratio, it means there's no earnings. So I don't know if that's such a good idea. But if the PE ratio is like, 600 or 1,000 or something, that tells you that, there's just not a lot of earnings there and stuff. And not that I'm giving stock advice here, I'm just saying it's prudent to gather as much information and then, kind of evaluate it and make a choice there. And once again, if you've got a trusted advisor, please go to them and see what they say about your questions and so forth. We're always more than happy to help and everything, but for the most part, there's a lot of information out there. I mean, you could go to the Springfield Public Library or go to their website, and you can tune into Morningstar or Value Line or a couple other publications, and start to educate yourself on some of these terms and strategies and things like that and stuff. And you'd be amazed at some of the information you can find there in the public library. I mean, they have a really, really, really nice research department, and a lot of the stuff is online, where, I mean, you can save yourself thousands of dollars in reports and stuff by just going there and using your library card to access some of this data. And with that, I think we're just about out of time. I see Matt poking his head in. I'm going to say goodbye. Next week, I'll probably have somebody here, because it's a lot more fun to bounce stories off of than me just rambling on. But hopefully today's show gave a few things that were of interest, and you liked the class on stewardship, or the course on stewardship and so forth. And, before I sign off real quick, I just want to say thanks to Pam and Jim Winey, and, of course, Dr. Paul. And we didn't mention much today about 7K metals. We normally do, because that's a great way to get some gold and silver at dealer direct pricing. These days, if you want to do that, you can go to 7kmetals.com/Paul Collins. And there's just a treasure trove of information there. And, feel free to go ahead and open an account and see, what kind of gold and silver you can add to your portfolio. And if you ever need help there, give us a call. 417-755-0700. Tony Hammock signing off. Have a great week, and we will see you next week. Thanks so much.